What if I told you that the United States' top financial regulator, the SEC, is about to flip its entire playbook, moving away from its reputation of crackdown first, ask questions later, toward a new promise of fairness, predictability, and due process? This could reshape Wall Street, redefine how cryptocurrencies are regulated, and even decide whether America remains the global leader in financial innovation or cedes that role to rivals like China and the European Union. Stay with us until the very end, because we're going to reveal how these reforms could unlock a 24/7 global financial marketplace that has never existed before. Before we begin, tell us in the comments, do you believe regulators should give companies a warning before taking action? Or do you think strict enforcement is the only way to protect investors? And don't forget to subscribe, because we've got exclusive analysis you won't see anywhere else. The announcement came in an interview with the Financial Times. SEC Chairman Paul Atkins promised that under his leadership, the commission would notify businesses of technical violations before bashing down their doors. This is not a small policy tweak. It represents a major cultural shift inside one of the most powerful regulators in the world. For decades, the SEC has been both feared and criticized for its unpredictable enforcement style. Fines in the billions, lawsuits that shook the foundations of Wall Street, and a shoot first, ask questions later mentality became part of its identity. Atkins is determined to change that. What I am trying to address is a market perception that there was a lack of due process, a lack of notice, and a lack of rule of law, he said. Why businesses criticized the SEC? The SEC's hardline approach did not come without consequences. Over the years, major banks complained of inconsistent enforcement that left them unable to plan ahead. Startups, especially in crypto and fintech, argued that innovation was being strangled by the fear of sudden shutdowns. Even federal judges raised concerns, warning that the SEC's tactics sometimes bordered on violating constitutional principles of due process. The result was an environment where companies operated with constant uncertainty. For smaller firms, a surprise SEC action could mean immediate collapse, even before a case was fully adjudicated. Atkins' promise is clear. The SEC will shift from being primarily an enforcer to also acting as a guide. Instead of leading with punishment, the agency will provide formal notice of technical violations, allow companies time to correct mistakes, develop predictable precedents so businesses understand the rules. This doesn't mean the SEC will abandon enforcement. Serious fraud and market manipulation will still face tough action. But the key change is proportionality, a recognition that not all violations are equal. The timing of this softer approach is striking, because the SEC is simultaneously preparing a sweeping rulemaking agenda that could redefine cryptocurrency regulation. For years, digital assets have lived in a gray zone. Previous SEC leadership often argued that most tokens were securities, making them subject to strict rules originally designed for stocks and bonds. This stance has been criticized for stifling innovation and pushing crypto businesses offshore. Atkins, however, signaled a different perspective. Most tokens are not securities. That opens the door to a fresh regulatory framework, one designed specifically for digital assets. Among the proposals, creating rules for tokenized versions of shares and bonds, granting these synthetic assets the same legal rights as traditional securities, allowing them to trade 24/7 on blockchain networks. This could be the breakthrough that finally brings crypto into the mainstream financial system. Imagine a world where Wall Street never sleeps. Today, stock exchanges open and close on a schedule. Settlement of trades can take days. Cross-border investing is slowed by layers of intermediaries. With tokenized assets, that could all change. Stocks and bonds could be represented on blockchain, cutting out middlemen. Transactions could settle in minutes, not days. Global investors could access U.S. assets at any time, without waiting for the opening bell. Costs of trading could fall dramatically. It's no exaggeration to call this a financial revolution in the making. Here's the critical point. The U.S. is not innovating in a vacuum. Around the world, rivals are moving fast. China has launched its digital yuan and is investing heavily in blockchain infrastructure. The European Union has passed sweeping regulations under MiCA, markets in crypto assets, to establish legal clarity. Singapore, Switzerland, and Dubai have positioned themselves as crypto-friendly hubs, attracting capital and talent. If the SEC's reforms succeed, the US could reassert leadership. But if they stall, America risks falling behind in the race to define the future of finance. So how are US financial giants responding to these signals from Atkins? Big banks are cautiously optimistic. They welcome the idea of predictability and the chance to experiment with blockchain without fear of immediate crackdowns. Crypto startups see this as validation of their long fight for legitimacy. The idea that most tokens are not securities could be a game changer. Investor protection groups, however, are sounding alarms. They argue that too soft a stance could open the door to fraud, scams, and market instability. This tension between innovation and protection has always defined the SEC's role. What changes now is the willingness to experiment with new frameworks instead of forcing old ones onto new technologies. While the opportunities are vast, the risks are real. Cybersecurity threats, 24/7 blockchain markets could be targets for hackers. Volatility, tokens could amplify price swings if trading is constant. Jurisdictional issues, how do you enforce US law in a decentralized global system? Systemic risk, could tokenized markets create new bubbles or hidden leverage, similar to what happened in 2008 with derivatives? Atkins' challenge will be to create guardrails that balance growth with stability. What's really at stake is more than just financial markets. It's the question of whether the US will lead the next wave of technological transformation. Just as America led with the internet in the 1990s, today it faces a similar crossroads with blockchain and digital assets. The SEC's choices in the coming months could determine whether the US sets global standards, or whether those standards are written elsewhere. So here's the bottom line. The SEC under Paul Atkins is promising a historic transformation, from unpredictable enforcement to transparent guidance. From treating crypto as a problem to recognizing its potential as the foundation of a new financial era. But is this the dawn of a fairer, more innovative market? Or could loosening the rules create the next big financial crisis? We want to hear from you. Should regulators give businesses a warning before cracking down? Would you trust a financial system that trades 24/7 on blockchain? And do you think America can maintain its leadership in finance? Or is it already falling behind? Drop your thoughts in the comments. We'll feature the best ones in our next report. And don't forget to like, subscribe, and hit the notification bell, because the story of how regulation, crypto, and Wall Street collide is just beginning. Stay tuned, because the future of finance is being written right now. Did you know that over 95% of our viewers aren't subscribed to the channel? We totally get it, life gets busy, and sometimes it's easy to forget. But here's the thing. Subscribing is completely free, and it really helps us keep creating the content you enjoy. So why not hit that subscribe button and join our community? It only takes a second, but it makes a world of difference to us. Thank you for your support.